Welcome to this Killik Explains finance video. This week a topical one. If you're around in the equity market last week, you kind of missed Ocado's massive share price bounce. What do we take away as equity investors? Is it just all good news? Not necessarily. Well, let's take a look at 3 lessons. So, just in case you missed it, just in case you had your head in a paper bag or something, or on holiday, last week Ocado shares rocketed by 45% in around a day. Pretty spectacular stuff, pretty unusual stuff. The reason was US firm Kroger came in, second biggest food retailer in the US, and basically took a 5% stake in return for a deal, the detail of which is still emerging, but it seems to be a rollout rights on Ocado's technology going forward in the US. That was big news. 5% may not sound like much to some people, but actually that deal eclipses previous ones, so other people have been sniffing around Ocado in the past, including Morrisons, Sobe, Casino, and ICA. So, the effect on the share price was pretty dramatic. After quite a period of drift, if you like, come back to that in a moment, there we've got a bit of a climb up in the early stages. At the start of this year, rumours around that maybe Amazon would go for a bid, and then suddenly, bang, right on the edge there, look at that, there's that 45% rocket bounce that I talked about. So, what are the lessons for investors? 3 takeaways in my view. 1, watch out for this. Some people will say, why would I diversify, compound over time when I can make 45% in a day? Why wouldn't I just put all my eggs in one basket and look for the next Ocado? Surely that's easier. No. Don't do single stock investing and don't try and time the market. Come back to why in a moment. Number 2, there are 2 sides to every stock story. In the media, over the last few years, it's all been quite doom and gloom around Ocado for reasons I'll come back to in a moment, but there are always 2 sides to every story. As an investor, you should have your eye on both sides. You've got to call it, you've got to essentially decide where you are ultimately on the stock, but be alert to the fact it's never a one-sided story. A market is all about buyers and sellers after all, different opinions. 3, if you didn't know this already, shorting shares is incredibly dangerous. If you get caught in a short squeeze, you can lose money hand over fist, and Ocado is a great example of exactly that happening to hedge funds and so on. So, with no more ado, single stock risk. In essence, what we're saying is owning single stocks is never a good idea. You might think you are going to pile into Ocado just before a bid from Kroger comes in, make 45% and go home very happy. But it's never that simple. Market timing is much more difficult than I just made it sound, because to make it sound easy, you need the benefit of something you don't have, which is called hindsight. All right. So that's gambling, not investing. All right. And you're relying on market timing, which is never a good idea to make money. Most people who get market timing right are usually lucky, even if they don't admit it at the time. It's also risky for income investors, just as it is for people trying to make a quick buck, by the way. Likes of BP, the likes of Tesco, the likes of G4S have shown that big dividend payers don't necessarily maintain their dividends. So if you back one horse, even the size of BP, it can all go wrong in the short term. All right. The solution, as we've said before, is to diversify across geography, across sector, across type, cyclical, defensive, and so on. And just to remind you, you don't need to own the whole market. Diversifying single stock risk away is actually relatively straightforward. Capital asset pricing market theory suggests that, which is what this slide's trying to show, around 15 to 25 stocks takes you down to a point where you've diversified most of the single stock risk away. Now, you haven't diversified market risk away, that's the risk the entire market crashes, but you have got rid of most of that single stock risk reasonably painlessly. So I don't want to hear people saying, nah, much easier to make 45% on Ocado in a day. No, stick to your knitting. Number 2, sentiment can shift quickly, and this is where you need to be aware of the fact there are 2 sides to every story. If you're diversified, of course, then this will have a less of an impact. But here's the point. Bears for years been saying Ocado's business model, it doesn't work. I mean, essentially they're delivering food to your front door. They don't have a sort of back-end retailer behind them, if you like, in the same way that Tesco's and Sainsbury's do. It's very difficult to make that profitable. The competition from other providers is increasing. The big supermarkets wading into the same space, if you like, the same concept. The valuation was way too high, way above Tesco and Sainsbury's in 2017, even at one point 50% above Amazon. Surely crazy stuff. And the firm has always struggled to break even, right? They've turned a small profit sometimes in the past, but nothing really to shout about. So the bear case was predicated on watching that share price drift, over a few years and saying, really, it's only a matter of time before this business model is shown up to be defective. The bulls said no. Ocado has grown to a decent point, 7% share of the UK online grocery market, and is enjoying revenue growth, and still is enjoying revenue growth. All right? Its automation and route mapping technology is remarkable, according to the Kroger CEO. It's cutting edge. All right? It's a trusted, well-rated brand, if you're someone who uses it, and as it happens, I am. It can boast logistics and technology as USPs. A lot of people think, well, it's just a website, you order food. No, the logistics technology behind it is phenomenal. And it's been a no-brainer target for a non-UK retailer for ages as a result. Quite a few people thinking, great, A, a way to get some proprietary distribution and logistics technology, and B, a way to break into the UK market and grab a bit of market share fairly quickly. All right? So no wonder Amazon was sniffing around ahead of Kroger coming in and actually saying, right, we're in for 5%. Number 3, short selling. Now, if you didn't know this is dangerous, Ocado is a classic example of demonstrating two things. One, hedge funds quite often get things wrong as well as right, even though they claim to be experts. And number 2, short selling is not for everyone. In fact, it's not for very many people at all. So there are several ways to bet on a share price falling. And around the time of the Kroger bid, about 7% of Ocado shares were thought to be on loan to short sellers. It's been much higher than that in the past, by the way. So short selling, by the way, in its pure form, is borrowing a stock, selling it, hoping to buy it back at a lower price before you have to return it. Most retail investors can't do that, probably a good thing, but they can get some of the action via short futures, CFDs and spread bets. But I'm suggesting watch out, because Ocado demonstrates something called the short squeeze, and it's phenomenally easy to lose money this way and lose it fast. So what is it? Imagine the Ocado share price, making up some facts here, rounding the numbers, is 400p. You borrow 1,000 shares and sell them immediately on into the market for 400p. The price then doubles to 800p. You've now got to return 1,000 shares to the original lender, and to do that, you'll need to buy them back, and to buy them back, you'll need to pay 800p. Your loss, therefore, is the difference. 400p times 1,000 shares, or £4,000. It's worse than that, because you've got to pay the original lender a fee on top. And in theory, by the way, your losses are uncapped, because the share price can keep rising, in theory, through the roof. So there's no limit to the amount you could lose. And a short squeeze is where, as somebody who has shorted stock like that, you're scrabbling around trying to buy the shares to close out the position, minimise your losses, and you can't get hold of them. So it's even worse when the stocks are liquid. Just to illustrate why hedge funds have been in the news on this issue, it tends to be pension funds often lending stock to hedge funds. What they do is then sell it in the open market at the 400p price I mentioned, for example. They then buy it back. Now, obviously, they're hoping to buy it back cheaper. That would be the point if you're betting on falling prices. Ocado showed that when you've got to buy it back more expensively, things go horribly wrong, and then return the shares plus a fee to the original lender, often a pension fund, a big institution. Motivations? Obviously, over here, the hedge fund's hoping that the price will drop in there and they'll make a profit, even taking account of the fee they pay to borrow the stock in the first place. Pension fund is thinking, well, I don't mind whether the shares go up, go down, I'm sitting on them for the long term, and if someone's willing to pay me a fee for borrowing them, so much the better. That improves my overall returns. So there you have it. 3 lessons for investors, quite big lessons, quite important lessons. Lots of ground covered. If you want to find out more, do email me, editor@killik.com. And if you want to see videos that cover some of the topics I've mentioned here fairly quickly, in more detail, then it's killik.com/learn.